If you want to retire early, you need income. And I'm going to show you how to pay $0 in taxes on 6 figures of portfolio withdrawals. For most people considering early retirement, the biggest roadblock isn't saving enough money. It's accessing your money without getting crushed by taxes and penalties. I talk about a lot of cool investment and tax strategies on this channel, but one of the most underrated tools for early retirees is a taxable brokerage account. It's a great way to bridge the gap between early retirement and age 59 and a half without early withdrawal penalties. And in this video, I'm going to show you how to do it. But first, if we haven't met yet, I'm Will Hinder, financial planner and IRS enrolled agent. And I spend my day-to-day running my financial planning firm and our tax office to help people just like you lower taxes, invest smarter, and make work optional. So if that sounds like something you'd like help with, grab some time with me at the link in the description. Let's get into it. Okay, first off, make sure you smash that subscribe button for real tax and financial planning strategies that actually show you how to lower taxes, invest smarter, and make work optional. So just the other day, the new IRS inflation adjustments came out for the 2026 tax year. And what really stood out was the additional tax-free money you can take in 2026 compared to 2025. And this is because both the standard deduction and the 0% long-term capital gains threshold went up. And the key here is understanding how these two powerful tax advantages work together. With no other income, you can generally realize long-term capital gains up to the sum of your standard deduction and the portion of the adjusted net capital gain that fits within the 0% capital gains band. The standard deduction first reduces taxable income to zero, and then the 0% rate applies to the remaining long-term capital gain that falls under the zero rate ceiling. So in other words, with no other income, you can stack the standard deduction and the 0% capital gain band to sell roughly that combined amount of long-term capital gains tax-free. Your standard deduction absorbs the first dollars of long-term capital gains by reducing taxable income to zero. Then the next dollars of adjusted net capital gain up to the 0% ceiling are taxed at 0%. Let's look at an example. For married filers, the 2025 standard deduction is $31,500, and the 0% long-term capital gains tax bracket starts with taxable income below $96,700. This means that in 2025, you could sell investments with $128,200 of long-term capital gain treatment and pay $0 in taxes if you have no other income, like many people in early retirement do in the beginning. But for 2026, the married standard deduction goes up to $32,200, and the 0% capital gains tax bracket now starts with taxable income below $98,900, which means you could sell $131,100 of stock with long-term capital gains treatment tax-free. And this is an extra $2,900 per year. And I didn't forget about you single filers. So in 2026, the standard deduction increased to $16,100, and the 0% long-term cap gain bracket starts with taxable income under $49,450 for a total of $65,550 you could potentially take tax-free if you have no other income and sold investments with long-term capital gains treatment. And this is an increase of $1,450 of tax-free money from 2025. And I know you're probably thinking, but I can't just log on to my brokerage account and just sell long-term capital gains only. Which is true, but practically speaking, you can target your gains by choosing which specific lots to sell. So you can actually choose to sell the shares with the lowest cost basis held over 1 year, aka the ones with the highest gain on paper, to fully maximize that 0% capital gains tax bracket. That way, you're clearing out the highest taxable gains while paying zero federal tax, leaving the highest cost shares in the portfolio to be specified when it's most beneficial. to either reduce future taxable gains or allow those shares to reach long-term holding status. And when we look at our different tax lots on our Charles Schwab brokerage account, we can see here that these lots are still taxed at a short-term treatment. So for this strategy, these are lots that we wouldn't want to sell at this point. When planning for early retirement, it's important to have a mix of different account types: taxable, pre-tax, and tax-free, because you can use each one at different times for different reasons. And that flexibility alone makes it a lot easier to structure your income in early retirement in a really tax-efficient way. So if early retirement is part of your plan, this is one of the cleanest ways to get income without paying a penny in federal tax. But it doesn't happen by accident. You need to plan for it now. So if you need help planning for early retirement or structuring your income in the most tax-efficient ways, grab some time with me at the link in the description. See you next time.